My name is Piet Viljoen. I'm the chairman and founder of RCM. I've been asked to speak about the outlook for 2012 and beyond. I think it's important to say that at RCM we don't invest based on the outlook, mainly because we do not know what the future holds. How we deal with uncertainty is by buying what is cheap. We like buying cheap, undervalued assets. The undervaluation protects us against the vagaries of the future. Unfortunately, by buying what is cheap means we are buying what is out of favor, and the market does not feel comfortable with that. The market likes stories, and the market likes the certainty that these stories gives it. If we just look back at the history of these stories, one can understand how this works. So we'll go back to the year 2000 with the tech bubble. That was the name of the story then. Y2K and all those sort of things. That was, the market was quite certain that that was the future, and they were investing based on that. It didn't turn out very well. In 2002, 2003, the story was we need to invest in London and New York. We need to get out of South Africa. There was a panic out of the rand. It traded very weakly against the US dollar and other currencies, and everyone was moving their money offshore. Corporates such as Investec, Dimension Data, Old Mutual and others were all moving their headquarters out of South Africa to London and New York. If one had invested based on that story, you would have lost out tremendously over the past 10 years. South African assets have done fantastically well. In 2006, 2007, the story was the commodity supercycle. You had to invest in anything that China was buying, and that was predominantly in mining type assets, cyclical commodity type assets. And we all know how that story fared through the global financial crisis of 2008, 2009. Today the story is, well, there's actually two parts to the story. The one part is I need income. That's the name given to the story, where everyone's clients is telling their financial advisor that they need income and that interest rates are too low, and therefore they need to buy the equity of stable companies that pay dividends, and that's how they're going to generate the income. The result is that these companies' share prices have been bid up to very high levels. And there's another story going around today, and that is I love Africa. All these corporates that were moving to London in 2002, 2003 are now moving to Africa. And again, I hesitate to invest based on either of those two stories. As I said earlier, we find protection against uncertainty in undervalued assets. In other words, assets where the story is bad, out of favor assets. That's why they're cheap. So today, what we are investing in is the equity of resource companies, specifically platinum companies, which are very high quality business but are out of favor for very obvious reasons today. We're investing in the hotel and gaming sector in South Africa, which, due to overcapacity created in the lead up to the Soccer World Cup of 2008 and the economic slowdown post the financial crisis, is going through tough times. That's another sector which is out of favor and cheap. And globally, we are seeing good value in good quality European companies, which are, for obvious reasons, out of favor. I mean, nobody wants to invest in Europe. Things look very bad there. And also in small and medium-sized companies of Japan, which has been out of favor for a very long time and is significantly undervalued at this time. So you can see the common denominator across everything that we are finding cheap today, and hopefully will protect us against any uncertain events in the future, are that they're out of favor and there are not nice stories being told about them. But that is how we've invested in the past. That is how we have protected clients' capital in the past, and we think that this investment strategy, consistently applied, will do so in the future again. Thank you very much for your time.